In a world where hopium and common sense collide, starring the CryptoKeeper and BlockchainCrusader. Welcome to Debate Crypto. Question everything, trust nothing. It's your boy CryptoKeeper here for the Fed meeting today. I hope you guys are excited for it. I know I am. Actually, I think it's going to be a big nothing burger, but you never know. You know what? I actually wore a special shirt for everybody. First of all, make sure you guys subscribe. If you're not subscribed, do your thing. Make sure you guys like the stream. As always, that helps us out as a channel, and we appreciate it. I can see it in the background, just letting you guys know. I've got it pinged up there. It's probably going to not actually start for about 15 minutes. And actually, Jerome Powell's announcement, I don't think actually starts. Like his actual speech doesn't start until I'm not sure if it's 2:15 or 2:30. Either way, I figure I'd jump on. We'll go over a little bit of crypto, and then we'll watch some of this. So hey, here we are. But I have a special shirt that I wore for you guys today, and I want to show you why. All right, so I've got my Boys in the Hood shirt on. Okay, now let's talk about why. Well, for those of you that haven't figured it out yet, the reason why is because we are about to watch a bunch of thugs in suits. Let that sink in, because ultimately what we have here is a large criminal enterprise called the U.S. government, who is in bed with a private company that ultimately is, that ultimately controls what us as U.S. citizens feel in terms of pain as it relates to monetary policy and what happens with the monies. So I wore my Boys in the Hood t-shirt today for one reason and one reason only, to give a big old thumbs up to the man and all these thugs in suits. So, Crypto fam, what is going on? Fearless in the house. Mike, appreciate the love there, brother. Says a very underrated channel. We appreciate that. You know what? I think it just takes time to grow. I think that's really what it is. It takes time to grow. We've only been at this for a few months, but I appreciate the love there. Certified TV, new sub. Heck yeah, I love that. And Diamond Hand Daryl. Love the name, brother. I am Diamond Hand myself, just depending on what asset we are holding. So let's check out the crypto market while we're waiting for this thing to kick off. Let's take a little peek at what's going on over here. Drum roll, please, for those of you that didn't know. Well, we've got a little pump. Global crypto market is at $1.78 trillion, a 2.47% increase over today. Bitcoin up over 40. Guys, this 40 number, psychologically, more than anything, psychologically, right here is freaking important. Okay, so remember that. Let's stay above 40. We're up a little bit over 3%. ETH, my girl, my baby, my side chick, 26.91, up about 4%. Tether holding strong at $1. BNB still under 400, but up a couple percent. XRP, you hurting me, baby. Under 80 cents again. We're down to 76 cents. Terra Luna down again. Actually, Terra Luna has made some wild swings this week. And actually, over the past few weeks, it's been absolutely unstoppable. And then it turns right back around. Who knows where that's headed? Then Cardano, Solana, and Avalanche rounding out the top 10. Up about a percent and a half, something like that. And one of the things that we've been doing is throwing an altcoin that we have been taking a look at recently. And yesterday it was Matic. Today it's Crow. Crypto.com, we talked about it a little bit last night, but Crypto.com is doing things that ultimately, I don't know what else you can say except for the fact that they are making moves, from the Super Bowl to what they're doing with institutional investors. They ultimately are just making big moves, and it's a really simple platform to use and utilize. I think they're going to continue to do well, especially as they have their name plastered all over every freaking thing around. Actually, let me share something real quick. Pull this up. All right, yeah, it's not up yet. Sorry, I had to kind of downsize it there for a second. But Bobby says hello from Italy. Hey, hello from Italy. Bobby, we are looking for a place out of the country to vacation. What are the conditions like for masking and other things over there? Let me know in the chat. I would appreciate it. OC Pet. Well, that we're waiting for Jerome Powell's speech. That's what I'm waiting for. So good afternoon, Juggernaut. We are waiting to hear Jerome Powell speak, and unless he spoke, and all of the other news outlets are just lying and not posting it, which hey, they're good at that as well. I'm waiting to hear him speak. I don't see. Yeah, we still got 9 minutes here. Is anyone else got something rocking? If something, if there is another one up, let me see. Let me see the meeting. If there's another one, I'll watch it. Yeah, I don't see. Mhm. Yeah, I don't see anyone else that has anything out right now in terms of his speech. I swear his speech doesn't start till at least 2:15 or 2:30. Yeah, why are these all, man, where did it go? You guys are killing me. Now you got me all sidetracked there, pet doctor. Now I'm looking. Hold on a second. Give me a second, guys. Uh I know I've got this yeah, right here. Yeah, so he's gonna be holding this in about 8 minutes. Looks like the speech is going to start, or at least the coverage of the speech is about to start. So that's what we're gonna be watching, and we can go over the information then because I want to hear what he has to say. Um, that's ultimately the way I would like to do this. Rest of the crypto markets, guys, are pretty flat. Not a lot of information going on right now. So I just wanted to chat with you, the chat, for a couple minutes. I can pull up. We can do some TA here in a second. But let me check into the chat real quick. Juggernaut, the man, the myth, the legend. Good afternoon, Mr. Robles, Connecticut, checking in. What's going on? Dominic, yeah, for whatever reason, I thought it was at 2:30 as well. I wanted to jump on at 2 o'clock and kind of chat with you guys, see what was going on. But Fox News is starting their coverage at 2:15. It says that it goes live at 2:15. Hey, I don't care what news station we get it from. I just want to hear what the man has to say. I think that it's important that when I was growing up, I always like I would hear my dad's an attorney, and I would wonder, like I would hear him like talk about certain things as it relates to politics, and I would hear like some of the things that he would listen to on the radio sometimes other than sports. And I always wondered, like, well, first of all, I was like boring, right, when I was young, but I had no appreciation for how much it affects us on a daily basis, right? I didn't start to really understand that until I got heavy into finance, heavy into the stock market, heavy into crypto. And once I realized, hey, you know what? How we vote does matter. Monetary policy does matter, right? These decisions made at a very high level. There's a saying that says crap rolls downhill. It's a fact, right? Let me explain to you how, like, gas prices, for example, are affecting myself as a business owner. Okay. I've got a guy that works for me that ultimately is a materials manager for my construction company. Okay. And ultimately, he also subs work from me from time to time. He actually started that way. Then he went on a salary position. And now he just isn't interested in doing the materials gig. Why? Because of gas prices, right? Even paying more money than anybody else, all of these things, right? So it does trickle downhill. And as gas prices go up, everyone's driving around and they're spending more money. And then the same job, right? Making these runs, well, they charge for the delivery fees go up. Everything goes up. Food is getting delivered. Guess what? Food prices are now going up. Well, they've been going up. And it's all a big farce for those of you thinking, well, Russia. No, no, it's not a fact at all. These prices have been going up ever since someone has got into office last year, and that's just a fact. So, Mark, good afternoon. Hey, in Columbus, heck yeah. OHIO. What's going on, Peter? We got people in from Toronto. We got all over the world today interested in seeing what Mr. Powell over here has to say. I really am interested in it. Let's take a peek at the charts. Certified asked if I was bullish on any altcoins. Yeah, I mean, to be honest with you, right now, although I think we're still going to see some sideways action, I still am bullish on the market. I don't think that we're going to take this massive hit at least anytime soon, unless we get some sort of catastrophic news, unless we hear something about World War III kicking off, or something wild like that. And I want to reiterate, I've said this a couple times before. If something like that happens, okay, it will hammer the market, but it will be short lived. So for those of you that are newer to the space, understand that I hate to say it like this because I was in the Marine Corps. War will ultimately be good for financial markets. Will be good for you, the investor, should you take advantage of the opportunity. I am not rooting for that, obviously, right? I'm not trying to pad my pockets off of war, unlike some of our government associates, if you will. But what I am saying is that when announcements like that happen, I am under the listen, not financial advice here, but I like to take advantage. When the virus stuff was happening back in March of 20, huge dips in the crypto market. I took advantage of that, right? I mean, I don't know what else you have to say. There's a reason that a lot of these high net worth individuals say never let a good crisis go to waste. It sounds terrible. It sounds absolutely just sideways, but the fact is, it does give you an opportunity, and people make more money during these down times if they're willing to say, you know what, I'll step up to the plate. I'll buy that. I will sit on that. They're able to make way more money. Think about being able to buy into a home, right? A few years ago before this market had absolutely gone nuts. Well, there you go, right? 2008, when the real estate market crashed, houses were literally a dime a dozen, and you could buy them incredibly cheap. What an investment that would have been had you bought up a bunch of rental properties back in 2008. That's kind of what I'm getting at. And so, yeah. Just want to throw that out there. Let me click over here and see. It says 2 minutes and 18 seconds. They're going to kick in. Let's do a little TA real quick. Let's see what's going on over. You know what? Can I add? I got about 2 minutes. I will do this. Hold on a second. Boom, 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 boom. Let's just check what's going on here. All right. So, oh wow. Well, we had a massive head and shoulders pattern that had been right here, right, which then gave us another little mini head and shoulders pattern, which was breaking down, and now we're back up to the upside, right? Ultimately, as I look at this real quick, we are making. Whoops. Come on, work with me. We are making higher lows, which is a good thing. But the reality is we've been trading in a big fat channel, with the exception of a few areas where we jumped up a little bit higher. We are still trading within these channels. Miguel has some of these overall, the pivots and quarterlies and all of that. I'm not going to jump into that right now. He usually goes over that. If you guys aren't following us already, make sure you subscribe. 7:15. Miguel's been the one doing the Fibonacci's and the pivots and all that good stuff. He's just better at the TA than I am. The RSI right now on the 4 hourly is about 50. So, dead smack in the middle of whether, hey, buy or sell, if you look at those as signals. Stochastic's a little bit high. The reality is, guys, we are all looking at things in anticipation, and the market is anticipating what's about to happen with this meeting, right? The market is anticipating and reacting to information. A lot of people are waiting to hear what the Fed has to say, and we're going to hear that here in just a minute. So yeah, if you guys got anything in the chat, toss it out there while we're waiting for him to come on. I thought, or I was hoping, I should say, not I thought, because I wasn't sure that he was going to be able to. I was hoping that that Miguel was going to be on here with me. Are they just literally going to have us sitting here at 2:15 and it's not actually going to start till 2:30? Well, if so, I definitely made a little mistake on that. We can absolutely jump into a little bit of news if we have to, if we're going to have 15 minutes. Give me 1 second, guys. Let me click over here and look at something real quick. That's not what we want to see. Yeah, they are actually, looks like we might be sitting here for a few minutes. Let's check out some news, guys. Give me just a second here. I'm going to pull up a little bit of news little crypto news, see what's going on. Top news here, and then I'll pull it up and I'll share my screen with you. Let's see what we got going on here. Bitcoin rises, stocks jump as leaders act. Let's jump into that one. Hold on one second here. We're going to kill a little bit of time here. Bitcoin rises, stocks jump as leaders act. All right. After days of trying to break through, Bitcoin has finally risen above 40,000, trading at 40,700 currently. Many reasons for it, but the primary one is probably because support at 39,000 turned out to be iron support. Bitcoin tried to fall below it amid market turmoil, but it held. And so now it tries the least resistance path. Folks, the least resistance path right now is up. On 4-hour candles, today's green is just a blip and barely noticeable. But after so much consolidation, investors may be looking for a breakout. This may be one of those instances where size doesn't matter, therefore, not more than the direction, with spring hopefully green to give a proper bounce, though 47,000 would have to come down first. Euro stocks are also green today, up 3.8% in the stocks index. That may be due to numerous reasons, including a gigantic $88 billion investment by Intel on Germany, France, Italy, and even Ireland, as well as Poland, for new semiconductor fabs. Guys, ultimately, when people are spending money to here's the deal. Our energy, we have an energy crisis going on, right? That's just a fact. Okay. We have an energy crisis going on. Juggernaut, you said I muted myself. You should be able to, I shouldn't be muted at all. There's an energy crisis going on right now, and we have to step our game up over here, or these prices are going to continue to absolutely just go out of control. I saw in California, I think it was California, $8 a gallon. If you're from the West Coast right now and you're in here, actually, if you're in the chat, drop me your gas prices right now. I want to see what gas prices are across the board here as we wait for Jerome Powell to come on board. Drop your gas prices in the chat. I'm really and then where you, and then tell me where you live. So drop a gas price and then where you live. I here in Ohio am looking at what was it? So I have premium. I think it was 459, 469, something like that. 650 in LA. Edward, we're waiting for the Fed for Jerome Powell to give his little meeting after the meeting minutes. Hold on, I'm gonna look at something real quick. Bada bing, bada boom. Here we go. Federal Reserve said it would lift interest rates and penciled in a series of further increases this year aimed at stopping the economy from overheating and reducing inflation. This is running at its highest level. That's running its highest levels in decades. U.S. stocks pared their gains after the Fed's announcements. Let's see here. So Fed officials boost inflation forecast by more than economists expected. The Fed lifted its 2022 inflation outlook by more than economists had been expecting ahead of the Federal Open Market Committee meeting. Forecasters had eyed around a 3.5% forecast for the core personal consumption expenditures from 2.7 projection officials offered in December. The Fed went further and now sees core inflation this year. What? Core inflation this year, 4.1% and overall 4.3%. These are big numbers. The central bankers see it. Relief only starts to kick in next year, although core prices even then are seen well above 2%, target 2.6%. This is absolute hogwash for those of you that haven't been paying attention. For them to say that they see core inflation at 4.1% and overall up 4.3%, like, guys, tell me in the chat if you're paying attention. Tell me you're lying. Tell me that they're lying to us without telling me that they're lying to us. We all know all you have to do, right, is walk outside of your home and go spend capital. Just go spend it. 4% as like a core rate of inflation. That's the most ridiculous thing I've ever heard. I could sit here and rattle off literally every single thing that I touch, see, buy, smell, anything on a regular daily basis is affected, and affected a lot more than 4%. I'm going to tell you something somebody told me this morning. I had a breakfast meeting this morning, right? Thanks, Crypto Cuban. Appreciate the love on that. I'm gonna tell you. I'm gonna tell you what I was told this morning. Somebody told me this morning that they bought, because I try my best not to eat fast food. I've been really working out hard and getting after it. But somebody told me this morning at a breakfast meeting that they bought a large fry yesterday from McDonald's. Right? No, Heidi, you didn't miss it. You didn't miss it. Uh, Somebody told me that they bought a large fry from McDonald's. It's actually gonna the actual video is going to be at Heidi. The actual video is going to start with Jerome Powell at 2:30. We got about 8 minutes, 9 minutes, something like that. But they told me a large fry, okay, was, guess what? Just take a wild guess. Drop it in the chat. It was freaking almost $4. How are you going to tell me when a freaking large French fry at McDonald's is almost $4 that core inflation is up 4%, right? 4%. Whitman said, I've seen a $6 gallon of milk. What? The only time I've ever seen a $6 gallon of milk is over in the Bahamas, where the island that we were on. The only way that you can get there is by like some little like ferry. And when I say ferry, like that's a nice way of calling it, right? It literally was like damn near like dude like rowing a boat with like consumer goods on it to get it over there. That's the only time I've ever seen that, right? So at any event, I don't know. Things are just going down the tubes right now, and we really need to pray for our nation. We really need to pray for our economy. We need to pray for our leaders. I know that a lot of people are going to say, well, what's prayer going to do? Well, first of all, I'm somebody that believes in the power of prayer. But second of all, the reality is I don't care if you are liberal or if you are conservative. I don't care what side of the street you sit on. I don't care how you think politically. I don't care if you think differently than I do, differently than the next person. No one can look at our economy right now. No one can look at the lives right now that we are living as it relates to just everyday things, everyday consumables, if you will, and say that we are in a good place. No one can look at our foreign monetary or our foreign policy and say that we're in a good place. No one can say that we are better off than we were a year and a half ago, 2 years ago, whatever the case may be. I don't know. It's just frustrating. Yeah, I totally agree, Bearded Crypto. Prayer, there is a lot of power in prayer, and we really do need to be praying for our country. There is no doubt. Barney says Peru. Been living here for 13 years. Food is up 20%. We are going to see a worldwide food shortage. It's happening as we speak. This is not me trying to throw fear out, but it is absolutely. Oh, let me click back there. It is happening. Okay. We're starting to see grocery shelves with less and less and less and less on them. We're starting to see, people paying enormous prices. We're starting to see people go to the store and stock up, stock up, stock up. Right. Miguel and I have, a mindset that we like to be prepared. Okay. And being prepared is not running to the grocery store, the moment you hear something bad and just stealing all the toilet paper, right? No, that's not what it's about. It's about taking steps towards like daily steps, monthly steps, yearly steps towards just being ready. Like, because things do happen and those shortages are coming, right? Um, Crypto Cuban, I can't agree with you more, right? I'm gonna throw this up here and I'm gonna put it away real quick because I can't really keep this on here too long. I'm probably gonna get in trouble for it, but you guys can read between the lines on that. But yes, I am 100% with you. Those are absolutely things that we need to be doing. I absolutely agree. Penelope says gardening needs to make a comeback. Penelope, people don't want to work anymore. Okay. I agree with you, right? But people, we have a society where everyone wants to basically, I don't know, cancel anybody that doesn't think the same way as them, see if they can get a check without working for it. I don't know. You don't want to get me started on that. Uh, but yeah. Let's see here. Bearded Crypto. Check this out. My wife has taken up canning and wants me to build some above ground garden beds, slowly trying to be a little bit more prepared and self sufficient. I'm with it, man. I am absolutely with it. I know a number of people that do this, and it can ultimately save you, even if it's just a short period of time, right? Being self sustainable is fantastic. Okay. And I think ultimately, if people could be more self-sustained, we wouldn't have to be so tied to the belt of our we wouldn't have to be the debt slaves as much as we are. No one anymore wants to basically be responsible for themselves. We live a life of convenience, and I'm guilty of it too. So don't think I'm on here saying that I don't live a good life, or that I don't take advantage of conveniences, because I do. Absolutely, I do. But what ultimately this whole ball of wax is about is that the world is headed in the wrong freaking direction, right? And so if we don't get some leadership in place, if we don't speak up and raise our voices and say, no, enough's enough, we will not be lied to anymore. You will not force this propaganda down our throats. You will not tell us, oh, look over here when there's something going on over here. That's what's happening right now. We live in a world where the news is propaganda, and you cannot trust. And I'm not just listen, I'm not the guy that says, yeah, don't listen to this news broadcast, but listen to this one. I'm not. Okay. I'm not. I am absolutely saying that across the board, there is propaganda flowing freely, and they know it. So I just have a real problem with a lot of that. We're getting close, guys. Let me see here. What are we at? We got about a couple minutes. Let me see if it is kicked. Nope, not yet. Looks like we got about what, 2 minutes, something like that. Chat, smash a one if you are expecting to hear anything super bullish for the crypto space. I'm going to toss this on here. Drop a one if you think this information that we're about to hear from the Fed chair is going to be bullish. Drop a two if you think it's going to be bearish. I'd like to hear what you guys think. I personally think that this rate hike has been baked in. I don't think we're going to. I think this is going to be kind of a nothing burger, but I ultimately want to hear it from their lips. I liked it. You can hear it from their lips, but watch their feet, right? There used to be a rap song called Watch My Feet, right? And ultimately, that's what we need to be doing. What are they actually doing? Not what are they saying? Because what are they saying has been a big load of hogwash. And I think we all know that. Fearless Rebel says bullish. Heidi says bearish, bullish, bearish, bullish and a half, or bearish and a half, however you want to look at that. Man, you guys, hey, right in the middle. Hensley, what's going on, brother? Hopefully all is well. 1.5 neutral. Yeah, I do. I think it's already been baked in, so I think it is going to be rather neutral myself as well, and we shall see. Well, William, I already knew. Man, you're killing me, brother. William is spoiling things in the chat. I want to hear what he says about it. I already knew that it was going to be a 25 basis points rate hike. But I want to hear what he has to say about it. That's what we're here for. So for those of you that haven't paid any attention, yes, there's a 25 basis, they call it basis points, rate hike. Okay. But they're expecting a lot more along the way. And I want to hear what Jerome Powell has to say about it. Because, it does affect the crypto space as a whole. For those of you that are here right now, the crypto space is absolutely for you. Why do I say that? I say that because things have been down, bearish, hard to stick around. That's what you have to do to be successful in this climate. That's what you have to do to be successful long-term in the crypto space. I'm telling you from experience. If Miguel was on here, he would agree. Here we go.
Good afternoon. I want to begin by acknowledging the tremendous hardship the Ukrainian people are suffering as a result of Russia's invasion. The human toll is tragic. The financial and economic implications for the global economy and the U.S. economy are highly uncertain. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today,
Nick DeBondi in the house.
The
What's up, brother?
FOMC raised its policy interest rate by 1/4 percentage point.
There it is, 1/4%.
The economy is very strong, and against the backdrop of an extremely tight labor market and high inflation, the committee anticipates that ongoing increases in the target range for the federal funds rate will be appropriate. In addition, we expect to begin reducing the size of our balance sheet at a coming meeting. Economic activity expanded at a robust 5.5% pace last year, reflecting progress on vaccinations and the reopening of the economy, fiscal and monetary policy support, and the healthy financial positions of households and businesses. The rapid spread of the Omicron variant led to some slowing in economic activity early this year, but cases have declined sharply since mid-January, and the slowdown seems to have been mild and brief. Although the invasion of Ukraine and related events represent a downside risk to the outlook for economic activity, FOMC participants continue to foresee solid growth. As shown in our summary of economic projections, the median projection for real GDP growth stands at 2.8% this year, 2.2% next year, and 2% in 2024. The labor market has continued to strengthen and is extremely
His mouth's
tight.
dry because he's lying.
Over the first 2 months of the year, employment rose by more than 1 million jobs. In February, the unemployment rate hit a post-pandemic low of 3.8%, a bit below the median of committee participants' estimates of its longer-run normal level. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. As a result, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. FOMC participants expect the labor market to remain strong, with the median projection for the unemployment rate declining to 3.5% by the end of this year and remaining near that level thereafter. Inflation remains well above our longer-run goal of 2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. These supply disruptions have been larger and longer lasting than anticipated, exacerbated by waves of the virus here and abroad, and price pressures have spread to a broader range of goods and services. Additionally, higher energy prices are driving up overall inflation.
Oh, I wonder why.
The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine will put additional upward pressure on near-term inflation here at home. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation. We know that the best thing we can do to support a strong labor market is to promote a long expansion, and that is only possible in an environment of price stability. As we emphasize in our policy statement, with appropriate firming in the stance of monetary policy, we expect inflation to return to 2% while the labor market remains strong. That said, inflation is likely to take longer to return to our price stability goal than previously expected. The median inflation projection of FOMC participants is 4.3% this year, and falls to 2.7% next year and 2.3% in 2024. This trajectory is notably higher than projected in December, and participants continue to see risks as weighted to the upside. The Fed's monetary policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people. Our policy has been adapting to the evolving economic environment, and it will continue to do so. As I noted, the committee raised the target range for the federal funds rate by 1/4 percentage point and anticipates that ongoing increases in the target range will be appropriate. The median projection for the appropriate level of the federal funds rate is 1.9% at the end of this year, a full percentage point higher than projected in December. Over the following 2 years, the median projection is 2.8%, somewhat higher than the median estimate of its longer-run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Reducing the size of our balance sheet will also play an important role in firming the stance of monetary policy. At our meeting that wrapped up today, the committee made good progress on a plan for reducing our securities holdings.
Boys in the Hood t-shirt.
And we expect to announce the beginning of balance sheet reduction at a coming meeting. In making decisions about interest rates and the balance sheet, we will be mindful of the broader context in markets and in the economy, and we will use our tools to support financial and macroeconomic stability. As we noted in our policy statement, the implications of Russia's invasion of Ukraine for the U.S. economy are highly uncertain. In addition to the direct effects from higher global oil and commodity prices, the invasion and related events may restrain economic activity abroad and further disrupt supply chains, which would create spillovers to the U.S. economy through trade and other channels.
They're preparing
the volatility
you.
in the financial markets, particularly if sustained, could also act to tighten credit conditions and affect the real economy. Making appropriate monetary policy in this environment requires a recognition that the economy often evolves in unexpected ways. We will need to be nimble in responding to incoming data and the evolving outlook. And we will strive to avoid adding uncertainty to what is already an extraordinarily challenging and uncertain moment. We are attentive to the risks of potential further upward pressure on inflation and inflation expectations. The committee is determined to take the measures necessary to restore price stability. The American economy is very strong and well positioned to handle tighter monetary policy. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
I always love these questions.
Gina at the New York Times.
Hi, Chair Powell. Thank you so much for taking our questions. I wonder if you could detail your thinking a little bit about how you're considering the risks of going too fast and potentially tipping the economy into recession, and how you're weighing those risks against the possibility of going too slowly, allowing inflation to become embedded and kind of getting behind the curve.
Oh, good question. For real.
So,
good question.
I guess I would start by saying that, in my view, the probability of a recession within the next year is not particularly elevated. And why do I say that? Aggregate demand is currently strong, and most forecasters expect it to remain so. If you look at the labor market, also very strong. Conditions are tight, and payroll job growth is continuing at very high levels. Household and business balance sheets.
Somebody
are
remind
strong.
me about the labor market.
And so all signs are that this is a strong
We'll
economy.
talk about that when this is over.
Indeed, one that will be able to flourish, not to say withstand, but certainly flourish as well in the face of less accommodative monetary policy. So I guess that's how I would say I'm looking at that. Of course, the objective is to achieve price stability while also sustaining a strong labor market, and that is our overall objective. But we do feel the economy is very strong and well positioned to withstand tighter monetary policy.
That was not the you didn't even answer the question.
Thank you. Let's go to Howard at Reuters.
What?
Hi, Chair Powell. I was wondering, in the SEPs, you have quite a markdown to GDP from 4 to 2.8%. I'm wondering, how much of that do you feel is a result of the Fed's stiffer than expected action here? You talk about monetary policy operating with a lag, but is this going to bite quicker than expected?
I don't think that's a big piece of it, actually. I think some of that is just an early assessment of the effects of spillovers from the war in Eastern Europe, which will hit our economy through a number of channels, highly uncertain. But you're looking at higher oil prices, higher commodity prices. It'll be so that we think that will weigh on GP to some extent. So that's part of what moved those assessments down. I think generally monetary policy works with a lag, so some of that would also be in there. But remember as well that 2.8% is still very strong growth. If we think that the potential growth rate of the economy is somewhere around 1.75%, 2.8% is strong economic growth. It would have been one of the strongest years, in fact, of the last expansion. So while it's lower
after you shut everything down, no wonder the freaking numbers are up. Come on, man.
So I would say it's quite a strong forecast.
This is horse hockey.
So in that context, what would trigger you to go faster or slower on the rate hikes? Ongoing increases doesn't really tell us whether this is going to come in bigger chunks or evenly paced through the year.
Yeah, so the way we're thinking about this is that every meeting is a live meeting, and we're going to be looking at evolving conditions. And if we do conclude that it would be appropriate to move more quickly to remove accommodation, then we'll do so. I can't be perfectly specific about it, but that's certainly a possibility as we go through.
Somebody needs to bring the heat on a question here. Bring some heat.
Thank you. Let's go to Rachel at the Washington Post.
Come on, Rachel, bring the heat.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I'm curious if you can be specific on when you expect to see inflation will start to come down, especially with the combination of rates going up, fiscal aid dissipating from the economy, and supply chains getting better. And if you don't start to see that, how will you signal it? What will you be looking for, and what will you be looking for over the course of the year? Thank you.
So I guess I would say that before the invasion of Ukraine by Russia, so let's go back to that. I would have said that the expectation was that inflation would peak sometime in the first quarter, maybe the end of the first quarter of this year, and then maybe stay at that level or a little bit lower, and then start to come down in the back half of the year. So now we're already seeing a little bit of short-term upward pressure in inflation due to higher oil prices. Not natural gas a little bit, but not so much for us since we have our own natural gas supply, other commodities prices. The other thing is that you're seeing supply chain issues around shipping and around, lots of countries and companies and people not wanting to touch Russian goods. So that's going to be more tangled supply chains. So that could actually push out the relief we were expecting on supply chains generally. So I guess I would say that the expectation is still that inflation will begin to come down in the second half of the year. But if you look at where I read the SEP headline median, we still expect inflation to be high this year, lower than last year. And then we expect, though, particularly with the effects of the war, but also the data we've seen so far this year, we expect inflation to remain high through the middle of the year, begin to come down, and then come down more sharply next year.
Let's go to Nick at the Wall Street Journal.
Okay, so, not me. No, different.
Nick Timmeros of the Wall Street Journal. Okay. Chair Powell, over the last 6 months, the Fed has shifted its policy stance quite a bit. 6 months ago, you were still buying assets. Most officials weren't projecting any interest rate increases this year. And yet, despite the shift over the last 6 months, real rates are as negative today as they were then. So how concerned are you that further inflation surprises will offset the effects of recent policy firming by leading real rates to stay at levels that do not actually provide much restraint to the economy? Thanks.
So that's one of many ways of capturing the situation, which is that the committee really does understand that the time for rate increases and for shrinking the balance sheet has come. And I would just say, I would go back to the economy is very strong. As I mentioned, tremendous momentum in the labor market. We expect growth to continue. It's clearly time to raise interest rates and begin the balance sheet shrinkage. And I just wanted to say that as I looked around the table at today's meeting, I saw a committee that's acutely aware of the need to return the economy to price stability and determined to use our tools to do exactly that. You couched it in terms of real rates. I would say if you look at the SEP, you've got people getting close to or even above, in many cases, their estimate of the longer run neutral rate. So I understand that doesn't do it for real rates, but if you go out a year or two, many people are in their forecasts are having tight policy from a real interest rate standpoint. So that's something that we're focused on. Of course, it's a highly uncertain environment, and you know, we don't know what's going to happen, but we do know that we're going to deploy our tools to achieve our goals, and that includes the price stability goal.
Let's go to Victoria at Politico.
Hi, Chair Powell. So looking at the summary of economic projections, you all have inflation coming down over the course of the year to 4.3%. And then you also have rates going up to what appears to still be below roughly what would be estimated to be the neutral rate, although I know that's a little bit uncertain. So I was just wondering, how much of inflation coming down do you see as actually being as a result of the Fed itself raising rates? And then also, if I could just ask, given that Sarah Bloom Raskin withdrew her nomination, what do you expect to do with the regulatory portfolio? Do you expect to assign a governor in charge of that?
Okay. So sorry, tell me again your first question.
My first question is, how much do you expect inflation to come down as
okay.
a direct result of the Fed's actions?
Okay, so part of inflation coming down at the very beginning is clearly to do with factors other than our policy, and those would include potentially the supply chains getting a little bit better. Certainly base effects. You're lapping, as you know, when you look at a 12-month trailing window, you're lapping very high inflation in March, April, May, June of last year. So there should be some effects from that in the 12-month picture. Really, what we're looking for, though, is month-by-month inflation coming down, and so it's really it's all the things we've been talking about, you know, that really haven't helped much, including the shift away from goods and back to services, including supply chains getting better, including labor force participation, all those things that have been sticky and not happening.
I wonder why.
But a big part of it is the base effects I mentioned as well. You know, I think monetary policy starts to bite on inflation and on growth with a lag, of course. And so you would see that more in 23 and 24. But also remember, we started talking about rate increases last year. For some months now, financial conditions have already incorporated a significant number of rate increases. So it doesn't start today. In effect, the moves are already priced into the market for a few months now. So so the clock is running on that, and I think some of that will be seen in the second half of the year as well. And on the regulatory portfolio, I would just say this: you know, we have an obligation to carry out under the law, in supervision and regulation, and we're doing that. That's what we're doing. The committee is not active, so what's happening is things are coming to the full board, and we're voting on them. We're getting our business done. You know, we got the stress tests done. We've looked at a number of proposals for mergers and things like that. So we're working ahead. Of course, we don't have a vice chair for supervision, as you mentioned, but we're making do with the situation we have, and a good number of things have come straight to the board for approval.
Let's go to Neil Irwin at Axios. Let's go to Neil Irwin.
Come on, Neil.
Hi, Chair Powell. It's Neil Irwin at Axios. Thanks for taking our questions. In the Statement of Economic Projections, we see a forecast of median 1.9% Fed fund rate at the end of the year, 2.8 end of next year. Wondered whether that aligns with your own expectations, in particular on that point of overshooting the long-term neutral rate. And also, if you can tell us anything about how that might be paced, front-loaded, back-loaded, how high is the bar for doing 50 at one meeting?
So I don't, Neil, I've never talked about my own SCP projection. It's in there, but I think
Freudian
Fed
slip.
chairs have generally not done that because we just haven't done it. It's because we have to put together the consensus on the committee and present that consensus. So I wouldn't talk about my individual one. And in terms of the pacing of it, I would just point out that there's 7 remaining meetings this year. This isn't something we discuss or debate or agree on, but there's 7 remaining meetings and there's 7 rate hikes. I would add there's also the shrinkage of the balance sheet, which people do the math different ways, but that might be the equivalent of another rate increase just from the runoff of the balance sheet. So I don't know. We haven't made any decisions on front end loading or going steadily through the year. And as I mentioned, if you look at the SEP, a good number of participants do see more than 7 rate increases this year. And I can't give you, I'm not going to try to give you a really specific test for what it would take to do that, but I will say this, though, we'll be looking at the data as they come in. We'll be looking to see whether the data show expected improvement on inflation. We'll be looking at the inflation outlook and making a judgment. And we'll be going, each meeting is a live meeting, and if we conclude that it would be appropriate to raise interest rates more quickly, then we'll do so.
So far, we have heard absolute trash. Bunch of BS, if you ask me. What are we doing here? Just sitting here looking at him. Lost audio. So let me go ahead and jump in here. Mr. Powell, first of all, your mouth is so dry because you have been lying incessantly to these people. Your note cards have been What's going on here?
Okay, we're going to try one more time. Colby Smith at the FT.
Can you guys hear that? Really? He didn't like this next question coming up.
Okay, we'll come back to Colby. Let's go to Edward Lawrence.
Yeah, thank you, Chair Powell. Thank you, Michelle, for the question. I have a more basic question. The last time the CPI inflation, I know you look at DC, but CPI inflation was as high as it is was July of 1981 when the effective federal funds rate was 19.2%. But given the current data, how far behind the curve of inflation do you believe the Federal Reserve is in your mind?
So I just would say a couple of things.
Let me not answer the question.
We have the tools that we need, and we're going to use them. And as you can see, we have a plan over
the Kamala Harris answer here
to raise interest rates steadily and also to run off the balance sheet. We will take the necessary steps to ensure that high inflation does not become entrenched while also supporting a strong labor market. And as I mentioned, if we conclude that it would be appropriate to move more quickly, we'll do so. I'll leave it to others to make the judgment you ask for.
And then just as a follow on that, I wanted to get you on the record on this. What impact has there been on your job, given the fact that you...
What? You can't make this up.
We lost you in the middle of the question.
You can't make this up. They did not like what he was about to ask. Let me get this on the record. They're like, whoop, let's get him out of here. Can't have that happening. Scoop.
That given you're not actually confirmed and Governor Brainerd is not actually confirmed, has there been any impact on your job or the Fed's ability to handle inflation?
None whatsoever.
Okay, let's go to Colby Smith at the FT.
Thank you, Michelle. Chair Powell, how concerned is the committee about the notable pickup in services inflation, which is perhaps less likely to self-correct? And to what extent does it alter both the committee's confidence that long-term inflation expectations will not de-anchor in the coming months, as well as the balance of risks that the Fed may need to raise interest rates further above neutral than indicated in the dot plot? Thank you.
Somebody needs to ask this guy, like, hey.
So of course, that's something we're watching report by report, and we're certainly we noticed it in the last meeting.
How long do you plan on lying?
It's part of the overall picture. We have expected services inflation to move back up to where it was, and that's part of what's happening is, in the case of some services, prices are still getting back up to where they were before the crisis. In other cases, it's pretty clear that inflation has spread more broadly across services, and yes, that is concerning. In the meanwhile, we see some progress on the goods side, but really in this latest report, it was confined to vehicles, which is admittedly a large a large category. So, as I mentioned, the committee acutely feels its obligation to move to make sure that we restore price stability, and is determined to use its tools to do so.
Thank you. Let's go to Steve Leisman at CNBC.
This will be a bunch of trash, I'm sure.
Thank you, Mr. Chairman. I wonder if you could help me understand the kind of logic, if there is one, inside the SCP here. As I look at the median forecast, for example, for unemployment, it runs for the 3-year window below the long run rate. I look at inflation being above over the 3-year window, the long run, or call it the neutral rate, so the economy still runs hot. And that is all true in a regime when you run, at least for 2 years, the funds rate above the long run rate. So I guess my question is this: are you not give a forecast here that essentially suggests you will be continuing to run further behind the curve and never really get in front of inflation because the economy will continue to run hot? And kind of on a related issue, you said earlier, inflation will take longer to return to price stability than we had originally expected. Isn't that a choice you're making? And if so, why are you making that choice to let inflation run above price stability longer than you'd like?
Right. So our if you look, first of all, there is no, you're looking at medians, but understand that there's no, it's not something we voted on. It's not a plan. But if you look, people do have their by the end of this year, broadly, people are at or close to, or in some cases above, their estimates of longer run neutral interest rate. Okay, so that should stop pushing, that should, in other words, that should be a removal of accommodation for monetary policy, basically. At the same time, we will have done significant balance sheet runoff, and you can think of that as further. In the next year, and just looking at the median, you're now above above the what people estimate to be the longer run median. So and also in many people's forecasts, that actually amounts to tight policy in real rates as well. So why does unemployment remain at 3.5%? I mean, a couple points. One is the connection between in the economy we had before the pandemic, the connection between inflation and the level of the unemployment rate was not very tight. But this is clearly what this is an expectation that really it amounts to that the idea that wage increases, which are now running above the level that would be consistent over the long run with 2% inflation, will move back down to levels which are still very attractive, full economy full employment kind of wages, but not to a point where they're pushing up inflation anymore. And as I mentioned, there are a lot of factors causing inflation to come down. And the reality is there are many moving pieces, and we don't know what will actually happen. But no matter what happens, this is a committee that is determined to use its tools to make sure that higher inflation does not become entrenched. And so we are determined on that front, and we'll deal with what comes. This is a modal or most likely expectation, but we'll deal with what comes, whether it's better or worse.
Thank you. Let's go to Chris Rugaber at the AP.
Hi, thank you. Well, let me follow up a bit on that. I mean, there are a lot of economists skeptical that you can reduce inflation as much as you've penciled in without raising the unemployment rate. And I'm wondering just what are the mechanisms you see in reducing demand? I mean, outside housing and autos, how do higher Fed rates reduce consumer demand unless it's through higher unemployment? Thank you.
Well, if you take a look at today's labor market, what you have is 1.7 plus job openings for every unemployed person. So that's a very tight labor market, tight to an unhealthy level, I would say. So, in principle, if let's say that our tools work about as you described, and the idea is we're trying to better align demand and supply, let's just say in the labor market. So it would actually
Smash a 1 in the chat if you think this is a bunch of
moving down the number of
BS.
job openings so that
A
they
2
were
if
more
you
like
believe
1
him.
to 1, you would have less upward pressure on wages. You would have a lot less of a labor shortage, which is going on pretty much across the economy. We're hearing from companies that they can't hire enough people. They're having a hard time hiring. So that's really the thinking there. Is these are fairly well understood channels, interest sensitive, and basically across the economy we'd like to slow demand so that it's better aligned with supply, give supply at the same time to recover, and get into a better a better alignment of supply and demand, and that over time should bring inflation down. And I'll say again though, we don't have a perfect crystal ball about the future, and we're prepared to use our tools as needed to restore price stability. With as I mentioned in my opening remarks, without price stability, you really can't have a sustained period of maximum employment. It's one of our most fundamental obligations is to maintain and restore, in this case, price stability. So we're very committed to that. Of course, the plan is to restore price stability while also sustaining a strong labor market. That is our intention, and we believe we can do that. But we have to restore price stability.
Okay, let's go to Scott Horsley at NPR.
What's 3, Edward?
Thanks, and I apologize if this covers some of the same ground you just talked about, Mr. Chairman. I think I missed some of your answer there, but I have a follow-up question on the labor force. We have seen some gains in the prime age workforce in the last few months. I wonder what you anticipate when it comes to some of the older workers as the health outlook has changed. Are we going to see more recent retirees following Tom Brady back in the workforce? And what would that mean for wages and inflation?
It's hard to say. What we saw in the last cycle was that over the course of a long, steady expansion, labor force participation outperformed expectations. And that was just it was a tight labor market, but it was nowhere near as tight as this labor market, but it was a tight labor market. And so people stayed in the labor force longer. It wasn't so much people coming back in the labor force after retirement.
They're coming
That's
back.
not something.
No, they're coming back from being kicked out of their freaking jobs.
Very much. But so that's what was happening. And more labor force participation is tremendously welcome. And of course, our policy does not in any way preclude that. This is a situation where wages have moved up at the highest rate in a very long time, and
that's not
people
true.
are able to quit their jobs and move to better paying jobs in the same industry or different industry. So
no,
it's a really attractive labor market.
That's a flat out lie.
And once as we get past COVID, well and truly, it becomes an even more attractive one. So we hope that will lead to more labor supply. That's a good thing for the country. It's a good thing for people. And it also will, we think, help relieve some of the wage pressures that do put inflation more at risk. That last part we'll have to see whether empirically it works out that way. But
Tom Brady's coming back because of inflation. He needs to be able to pay for stuff.
It's not the only thing we're looking for, though, from inflation. We're looking for help from a number of different places, and most importantly, from our own policy.
Okay, let's go to Rich Miller at Bloomberg.
Thank you, Michelle, and thank you, Chair Powell. I'm sorry, I'm having some communication problems, so I've missed some of the stuff you've said, and my apologies if this has been asked. Since the FOMC met last January, financial conditions have tightened markedly. Equity prices down, treasury yields up, bond spreads risen, yield curve has flattened a lot, and even further this today, dollar is up. Is that welcome, and would you like to see more in order to achieve your goals? Thank you.
So as you know, policy works through financial conditions. That's how it reaches the real economy, by just the mechanisms you mentioned. And remember that the financial conditions we had for the last couple of years were a function not only of very aggressive and appropriately so fiscal policy, but also highly accommodative monetary policy. The monetary policy settings that we put in place at the worst parts of the pandemic. So it is very appropriate to move away from those. And yes, that will lead to some tightening in financial conditions in the form of higher interest rates and and just the sorts of things. We're not targeting any one or more of those things, but financial conditions generally should move to a more normal level, so that because we know the economy no longer needs or wants these very highly accommodative this stance, which, so it's time to move to a more normal setting of financial conditions, and we do that by moving monetary policy itself to more normal levels.
When you say move to a more normal setting for financial conditions, that suggests to me that you want financial conditions to tighten further from where we are now. Am I drawing the right inference from that?
Well, yes. So I would say we look at a broad range of financial conditions, and of course, when we tighten monetary policy, we do expect that they will adjust in sync over time with monetary policy. It's not any particular financial condition, but a broad range of financial conditions. They will reflect, to some extent, they reflect any number of things. But yes, we need our policy to transmit to the real economy, and it does so through financial conditions, which means as we tighten policy or remove accommodation so that it's at least less accommodative, that broader financial conditions will also be less accommodative.
You do know they don't speak English on
Just a
these
little
to confuse as
housekeeping
many
note.
people as possible.
Those of you in this call may be having some tech issues. If so, I understand the broadcast is coming through clearly on www.federalreserve.gov.
On
So you might go there for
YouTube
the audio.
with
And now
Debate
we'll go to
Crypto.
Gene Young.
Just watch it on Debate Crypto. You guys will be good. Better there, actually. You'll be fed actual truth.
Hi, Chair Powell. I wanted to ask about the balance sheet discussion you've had at this meeting. Can you give us any more details? Did you discuss whether to cap runoffs or whether to increase those caps over what period, if there were any details?
Yes, thank you for asking. So at our meeting today and yesterday, we made excellent progress toward agreeing on the parameters of a plan to shrink the balance sheet. And I'd say we're now in a position to finalize and implement that plan so that we're actually beginning runoff at a coming meeting, and that could come as soon as our next meeting in May. That's not a decision that we've made, but
He's
I would
looking
say
down
that
at all
that's
his notes. Yes.
That's how well our discussions went in the last 2 days. So a couple things just to add. We'll be mindful of the broader financial and economic context when we make the decision on timing, and we always want to use our tools to support macroeconomic and financial stability. We want to avoid adding uncertainty to what's a highly uncertain situation already. So all of that will go into the thinking of the timing around this. In terms of the, I would say this. I don't want to get too much into the details because
I don't have
we're
notes on this.
We're literally just
But I'm gonna
finalizing
talk
them.
on it.
But the framework is going to look very familiar to people who are familiar with the last time we did this. But it'll be faster than the last time, and of course it's much sooner in the cycle than last time. But it will look familiar to you, and I would also say that there'll be I'm sure there'll be a more detailed discussion of our in the minutes to our meeting that come out in 3 weeks, where I expect that it will lay out pretty much the parameters of what we're looking at, which I think will look quite familiar.
Thank you. Let's go to Michael McKee at Bloomberg TV.
Mr. Chairman, since September of 2020, you've been operating on a monetary policy framework that let the economy run hot to bring unemployment down. That seems to be over, but I'm wondering how you would describe your reaction function now. What is it that the Fed is trying to do other than bring inflation down? And in other words, is it we're going to keep raising rates until it comes down to an acceptable level?
Yeah, so I want to clear one thing up again, and that is that
besides your throat,
nothing in our new framework or in the changes that we made has caused us to wait longer to raise interest rates. What we said in the framework changes was, and this was really a reflection of what had happened for the preceding couple of decades, actually. What we said was, if we see low unemployment, high employment, but we don't see inflation, then we're not going to raise rates till we actually see inflation. That's what we said, and that was the sense of it. There was no sense in which if we got a burst of really high inflation, we would wait to raise rates. That's simply not in the framework. In fact, quite the contrary. The framework is all about anchoring inflation expectations at 2%.
You knew inflation was coming.
I do hear this, that the framework, it really, we can't blame the framework. It was a sudden, unexpected burst of inflation, and then it was the reaction to it, and it was what it was. But it was not in any way caused by or related to the framework. So come to today. I think our vision on this on the committee is very, very clear. What we see is a strong labor market. We see a labor market with a lot of momentum, great job creation, and we see the underlying economy strong. Balance sheets are strong. Yes, there are threats to growth from what's going on in Eastern Europe.
No, from what's going on right here.
But nonetheless, in the base case, there's a pretty broad expectation of strong growth. But inflation is far above our target. And the help we've been expecting and other forecasters have been expecting from supply side improvement, labor force participation, bottlenecks, all those things getting better, it hasn't come. And so we're looking now to using our tools to restore price stability, and we're committed to doing that. And you see that, I think, in the summary of economic projections, and you see that in the decision we make, and you will continue to see it in the decisions we make going forward.
If I could follow up by asking, I guess what you'd call it is the Paul Volcker question. You don't think unemployment is going to rise significantly, but if it does that temper your desire to keep raising rates?
Well, the goal, of course, is to restore price stability while also sustaining a strong labor market. We have a dual mandate and they're sort of equal. But as I said earlier, price stability is an essential goal. In fact, it's a precondition really for achieving the kind of labor market that we want, which is a strong and sustained labor market. We saw the benefits of a long expansion, a sustained labor market. It pulled people back in, and there were really no imbalances in the economy that threatened the long expansion. The pandemic arrived. It was just a completely exogenous event. So that's how we're thinking about it. We of course want to achieve price stability with a strong labor market, but we do understand also that really you can't have maximum employment for any sustained period without price stability. So we need to focus on price stability, in particularly because the labor market is so strong and the economy is so strong. We feel like the economy can handle tighter monetary policy.
Wow.
Thank you. Let's go to Brian Chung at Yahoo.
Hi, Jerome Powell. Hopefully no tech issues here on this front. Wanted to ask just kind of the broad question about how you are communicating what the Fed's doing here today to the average American who might not be reading the dot plots or understanding what the SCP is. How is the 25 basis point hike today and then the signaling on future Fed policy going to address the inflation that they're feeling at the stores on a daily basis?
Great question.
Sure. So I guess I'd start by just assuring everyone that we're fully committed to bringing inflation back down and also sustaining the economic expansion. We do understand that these higher prices, no matter what the source, have real effects on people's well-being. And really, high inflation takes a toll on everyone, but it's really especially on people who use most of their income to buy essentials like food, housing, and transportation, where, we've all seen charts that show if you're a middle-income person, you've got room to absorb some inflation. If you're at the lower end of the income spectrum,
why don't you absorb
it's very hard because you're spending most of your
Stop spending money out of the
on
country.
Necessities and the price is going up. So, but it's punishing for everyone. So it has been a difficult time for the economy, but we do anticipate that inflation will move back down, as I mentioned earlier. It may take longer than we like, but I'm confident that we'll use our tools to bring inflation down. And you ask about rates. So the way that works, I would explain, is as we raise interest rates, that should gradually slow down demand for the interest-sensitive parts of the economy. And so what we would see is demand slowing down, but just enough so that it's better matched with supply, and that will bring inflation down over time. That's our plan.
Thank you. Let's go to Jolene Kent at NBC News.
Hi, Chair Powell. Thank you so much for taking my question, doing this today. My question is a follow-up to what Brian just asked. What is your message to consumers out there who can no longer afford the basics due to this high inflation?
Well, that is, yes, indeed. I mean, as I just said, I think we do understand very much, and we very much take to heart that it's our obligation to restore price stability. And we've had price stability for a very long time, and maybe come to take it for granted. But now we see the pain. I'm old enough to remember what very high inflation was like, and we're strongly committed as a committee to not allowing this higher inflation to become entrenched, and to use our tools to bring inflation back down to more normal levels, which our target is 2% inflation. So we will do that, and I just would want people to understand that, but the way we do that is by raising interest rates and by shrinking our balance sheet. And so financial conditions will become, at the margin, less supportive of various kinds of economic activity. That will slow the economy, while also allowing the labor market to remain very strong. And the good news is the economy and the labor market are quite strong. And
nobody's told us that today yet.
The economy, we think, can handle interest rate increases.
If it's 7.9 right now, 2% is actually more like 10
Federal
probably.
Reserve walking this very complicated fine line, trying to avoid a recession. For the consumers out there who are worried about their jobs and a possible recession, what do you say to that?
Well, I say that our intention is to bring inflation back down to 2% while still sustaining a strong labor market, and that the economy is very strong. If you look at where forecasts are, people are forecasting growth that's strong within the context of U.S. potential economic output.
And we have the tools.
And we expect that to continue. And to the extent the data come in different, then of course our policy will adapt. But we do believe that our policy is the appropriate one for this forecast, and we believe that we can bring down inflation. We believe that we can do so while sustaining a strong labor market. The labor market
We've got the tools to do it.
It's not strong in the ordinary sense of the world. We have not seen a labor market where there are 1.7 job openings for every unemployed person, or where if you add job openings to those who are employed, that's actually substantially a larger number than the size of the workforce, than the number of people who actually count themselves as in the workforce. So this is a situation where demand is higher than supply. And when that happens, prices go up. So we need to use our tools to move supply and demand back in. We don't think we need to do this alone. There will be other factors helping that happen, but we certainly are prepared to use our tools, and we will.
Thank you.
Thank you. Let's go to Simon at The Economist.
Thank you, Michelle. Thank you, Chair Powell. Sorry to take you away from inflation for 1 minute. May I ask about the sanctions on Russia, and specifically the freezing of the central bank assets? Of course, that raises
you mean like 6 of the 100 banks?
Sovereigns around the world and their biggest companies potentially. Any concerns about, in the long term, how this might affect the dollar's status as the preeminent global reserve currency? And in the past couple of weeks, have you had to deliver any kinds of reassurance to other central bankers around the world?
Well, so of course, central bankers around the world are generally very, very in favor of these sanctions. But let me say this: sanctions are really the business of the elected government, and that's true everywhere. So the administration, the Treasury Department in particular, and other agencies, they create these sanctions. We're there to provide technical expertise, but it's not our decisions. So I'm reluctant to comment on sanctions really much because again, they're not for us. We have a very specific mandate, and these are really the province of elected governments, as I mentioned. So
yeah, because you have nothing to do with the elected government at all. Nothing. No.
Thank you. Let's go to Nancy Marshall-Genzer at Marketplace.
Hi, Chair Powell. Thanks for taking the question. You've been talking a lot about rising wages, which on the one hand is a great thing, but are we possibly seeing the beginning of a wage price spiral?
Wage price spiral.
So the way I would say it is this: we first of all, I would agree with the premise that wages moving up is a great thing. That's how the standard of living rises over time, and generally it's
is
driven
it?
over long
Because
periods
if the
by
cost of
rising
goods
productivity.
outpaces it, you're screwed.
But
thanks.
What we have now, if you look at these the wage increases that we have, we look at we're blessed with a range of measures of wages that all measure different things. But right now they're all showing the same thing, which is that the increases, not the levels, but the increases are running at levels that are well above what would be consistent with 2% inflation,
That's
our goal,
freaking not true.
over time.
That's a lie.
And that may be, we don't know how persistent that phenomenon will be. It's very hard to say. And that's really, I think, the sense of your question about a wage price spiral is that something that's going to start happening and become entrenched in the system? We don't see that. You can see, for example, in some sectors that got very high wage increases early on, those wage increases look like they may have slowed down to a normal level. But it comes back to, what I'm saying here, which is there's a misalignment of demand and supply, particularly in the labor market, and that is leading to wages moving up at ways that are not consistent with 2% inflation over time. And so we need to use our tools to guide inflation back down to 2%.
What's the over-under on
and that would be
number
in
of
the
times he says
context
tool
of
again?
an extraordinarily strong labor market. We think this labor market can handle, as I mentioned, tighter monetary policy, and the overall economy can as well. But yes, wages are moving up faster than is consistent with 2% inflation. But it's good to see them moving up. But it wouldn't be sustainable over too long of a period to see them moving up that much higher. And that's because of this misalignment between supply and demand.
No, he said they're raising it more than 2%.
Supply. We did last time. We got more than we expected during the last cycle. This time we've gotten much less than expected. So it's not easy to predict these things. But we do expect that we'll get people coming back in the labor market, particularly as COVID becomes less and less of a factor in many people's lives, something we all wish. So that's how we think about it.
Thank you. And for the last question, we'll go to Don Lee at LA Times.
Hi, Chair Powell. I think you said to the Senate earlier this month that in hindsight, the Fed should have moved earlier. And it sounds like today that you don't think that the Fed is late. And I just wanted to get your clarification on that. And if it is, if you still think that the Fed is behind the curve, how much behind the curve is it?
Right. So we are not.
That's not.
We don't have the luxury of 20/20 hindsight in actually implementing real-time decisions in the world. So, the question is, the right question is, did you make the right decisions based on what you knew at the time? But that's not the question I was answering, which is knowing what you know now. So I think if we knew now, of course, if we knew now that these supply blockages really and the inflation resulting from them in collision with very strong demand, if we knew that was what was going to happen, then in hindsight, yes, it would have been appropriate to move earlier. Obviously, it would be, but again, we don't have that luxury. And then but that's a separate question from your other question, which is behind the curve. And I don't have the luxury of looking at it that way. We have our tools, powerful tools, and the committee is very focused on using them. We're acutely aware of the need to restore price stability while keeping a strong labor market. And what I saw today was a committee that is strongly committed to achieving price stability, in particular, and prepared to use our tools to do that. We're not going to let high inflation become entrenched. The costs of that would be too high. And we're not going to wait so long that we have to do that. No one wants to have to really put restrictive monetary policy on in order to get inflation back down. So, frankly, the need is one of getting rates back up to more neutral levels as quickly as we practicably can, and then moving beyond that if that turns out to be appropriate. And as you can see, it is appropriate in the sense to people's SEPs. They do write down levels of interest rates that are above their their estimate of the longer run neutral rate. And there's also a range of estimates too, as you will see if you look at the details of the SEP. But thanks for your question.
Okay, thank you all. Thanks, Mr. Chair.
Thank you.
All right. Well, there it was. So, for those of you that that didn't know, the tools they have the tools. Okay, so that's what you need to know. You need to know that the labor market is as strong as ever. Which, let's start off with that. That is a freaking lie. I will tell you, owning multiple businesses at this point, that one of the hardest things to find right now is people to work. Okay. It's not even that. It's that you get problems like, oh my gosh, all of the other things happening, right? Like the gas prices, for example, at this point. Well, it cost me so much to get from point A to point B that I need more money. And like I said, it gets passed on and passed on and passed on and passed on. It doesn't just sit in one place and then the rest of the world just keeps on living. No, crap rolls downhill. We've talked about it. Labor market. The only reason that he can say with a straight face that the labor market is up, right, is because they shut it all down. They shut it down. They shut the whole labor market down. Not the whole labor market, but most non-essentials, right? And it's comical. It's literally like, hey, what is the most effective way that I can lie to the American people? Well, I mean, let's just tell them the truth. Well, the labor market's strong right now. People are coming back to work more than ever. Oh, really? How tough is that? You just freaking can everybody, and then you start saying, oh, hey, guys, you can come back to work. And everybody starts coming back, and you're like, man, the labor market is super strong. Get the heck out of here. William wants to know, how screwed are we? William, I think we're in trouble. I think that we are going to genuinely I think we are going to have food shortages. It's already happening. I think that inflation is going to run away from what they believe. I believe that inflation is going to run away from them and that they don't have the tools to fix this. Okay. I don't. Here it is. Check it out. I actually got banned. I didn't get banned. I got a community guidelines violation for saying this in a TikTok a while ago, and it had hundreds of thousands of likes on it. It was one of my best videos. And I basically said the only way that we are going to be able to save the US dollar or the economy is to crush it. And right now, with where we're at, let's say we can't go back and change things because we can't. The only thing that we really can do to save the dollar is to blast interest rates through the roof. Okay. What's that going to do? That's going to cause stagflation. Okay. People are going to ultimately not want to spend money, right? Which then leads to deflation, which you're thinking, well, wait a minute, that makes the dollar stronger. You're right, it does, but it makes the real value of debt higher. So ultimately, in the long run, people are now not spending, which is not stimulating the economy. Okay. I'm just breaking this down for you. So we get stagflation first, okay? People are not spending. Economy is not stimulated. These companies aren't making the money they want to make. They have to sell basically for higher prices, less product to be able to continue to do the same things that they were doing before. That hurts, right? Oh, shoot, we're not able to do that. Well, we need to start laying people off. So ultimately, as you can see, it spirals, okay? Then once we get past the stagflation and people start to spend, or if they do, it leads to deflation. What's the problem with deflation? Well, the problem with deflation is, just ask Japan, but the problem with deflation partially is the value of debt becomes much higher. As inflation continues to go through the roof, right? If we were able to pace that with our income, which we're not going to be able to. That's not real life. People are not pacing. Listen, they're already lying to us about what the rate of inflation is. Let's be real. 7.9%, that's a joke. You can go and look at anything, anywhere, how much prices have risen. It's a joke. The CPI numbers are manipulated. They know it, and I hope you know it. And if you didn't know it before now, you know it now, okay? If you were able to make money outpacing the amount of inflation, you would be able to pay off your house much faster, because guess what? I still only owe the same amount of money, right? So if I owe $500K on a house and all of a sudden I'm outpacing inflation with my income, but that $500K is still what I owe, I'm going to pay it off faster. Well, on the opposite side of that, with deflation, when the dollar becomes more and more valuable, people aren't able to hire as effectively, keep as many people going. They're going to want to drop wages, which nobody wants to take a drop in pay. They only want a hike in pay. The value, the real value of that 500K on that house is a lot freaking higher, and it's a lot harder to pay off. That's where we're headed. Okay. That is where we're headed. And ultimately, I don't know why. Do you know how much respect I would give? And listen, I know this isn't about me, right? And it's not about you. They'll tell you that it is, but it's not. Do you know how much respect I would give somebody to walk out on a platform like that and say, listen, we did not handle this correctly. You, the American people, are going to suffer as a result. Here are, as best of our ability, the real numbers, and here is the real economic impact of what we've done. I think people would fall over. I would. If I literally got on there and saw someone taking responsibility, I'd be looking around wondering if Jesus is coming back. Like, wait a minute, Jesus is coming back. Because it's absolutely, it never happened. They won't do it. They won't take responsibility. All we're looking for, all they, I should say, are looking for is a finger to point. And they want to point their finger at anything but themselves. What you need to remember is when you point your finger at someone, you have 3, 1, 2, 3 pointing back at you. And that's where we're at right now. Our economy, our economic and financial fiscal policy decisions have led us to where we are at today. Gas prices are because of us, not Russia. Inflation because of us, not directly COVID, right? COVID because of us. Again, I don't want to get demonetized here. Probably already did just from saying the boogeyman name that I'm not allowed to say. But the reality is we put ourselves in this position. And here's the deal. I talk with Miguel about this a lot. The people that are in office they're not, I know you want to say that they're stupid, but they aren't. That's my problem, though. We're not dealing with a freaking monkey that understands some things, but doesn't actually really grasp what's going on. When the money printer was going burr and they continue to do it, what, economics 101? What do you learn that in 9th grade, right? You have what's called supply and demand. And when we drastically increase the supply of money, what did we think was going to happen? And so my problem is we have some very, very intelligent people that have gotten to where they are, whether they're greasing hands, whether they're being shady, whether they're not stupid, and they knew what was happening. So ultimately, guys, this is not headed in a direction that any of you are probably going to like. That's just a fact. Inflation is going to continue to rise. Interest rates are now going to rise, which if you didn't know, this is going to make loans much more difficult to obtain. Interest rates. I was actually just talking to a mortgage broker this morning. I haven't bought a house recently. Well, I bought a house a year ago, but I haven't bought a house, in the past few months, and rates are already up right now quite a bit, even from last year. I think we bought our house at 2.39%. She was telling me that rates are at 4.25%. That's a big difference, and as it relates to mortgages, and it's going to make it harder for people to get, which then ultimately businesses that are living off of what we call OPM, other people's money, aren't able to get that. It all gets passed on to the consumer. Lumber prices are up, gas prices are up, transportation's up. Now everybody wants to get paid more money. Blah, 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 blah. Right? And the only way that we can ultimately fix this right now is to crush our economy. So we have 2 options here, and you can clip this if you want. We are either going to absolutely raise rates through the roof with some speed, whatever, and the economy goes into a recession, but it saves the dollar, or we print ourselves into hyperinflation and we lose the dollar, which I think may have been the idea all along, to move us over to central bank digital currencies, i.e. the digital dollar. I have over my shoulder here the answer to a lot of this. Bitcoin, Ethereum, these cryptocurrencies ultimately will and do change some of these problems. Bitcoin is barely at all, if any, inflationary. 21 million will only ever exist. And the idea of value is what two people agree on. So if the whole world agrees that Bitcoin has value, then it has value, and it has intrinsic value in its supply and demand that we can't just turn on the money printer and go burr. There are solutions. They don't like the solutions because the solutions don't involve a centralized entity, i.e. our government making decisions. Unless Bitcoin was created by our government, or if our government is going to find a way to reach in there and grab hold of the proverbial, grab hold of those, right? And twist, if they don't have that control, they're not going to allow it to happen. It is why policies are dropping left and right on what you can and can't do with decentralized finance. Crypto is in the mainstream right now because the government is trying to figure out how to control it. How do we take the next step forward, and how can we make money off of what all of these people have figured out is the biggest Ponzi scheme in the world, which is the US dollar. That's where we are. Okay. Excuse me. Now, let me get to the chat real quick. Let's chat. Let's get to the chat for let's get to the chat for a little bit. So Hensley says Powell will be the scapegoat. Yeah, I mean, ultimately he is the messenger. It is not it's not him that is making all of these decisions. It is a big group of people. It's not even that big of a group, but ultimately there's basically, I think it's 12. I think it's like 12 people that make these decisions. And, they are not going to be the ones that are going to feel the effects that you and I feel on a daily basis. Right. So, hey, it is what it is. Florida Life says he's been in government 40 plus years, knows exactly what he's doing. Yeah, I know what you're talking about. You're saying that's your issue with our current president. Yeah. Like they do know what they have put out there. So, the reality is, I hope that if nothing else, I have described to you in a simple way how some of this monetary policy and how some of the things that are going on in our economy right now affect you, the consumer, the middle class, the lower, the upper. I don't care what class you're in, right? We always try to distinguish one person from another. How about just people, right? How about we're just people? We're just people. I don't care what color your skin is. I don't care what class you're in. The reality is this affects people in a very real way. And if we don't get some people in office that have some kahunas, right, and are willing to make some decisions for our country and not take our money and spend it elsewhere and then point at other countries and say they're the problem, guys, we're in for a rude awakening. So ultimately, what do we need to do? We need to pray for our leaders. We need to pray for our country. You need to pray for yourselves. We need to work hard, and we need to buy Bitcoin. And on that note, I want you guys to know something. I love each and every one of you. Please make sure that you guys smash the likes. Make sure that you subscribe if you haven't already done that. We really do appreciate all of your support. Continue to blow up the channel. Share this out to people. Let people know Debate Crypto is here for you. Because after all, you better question everything and trust nothing. Because until next time, you need to hodl like it's hot. I will see you soon. Have a great day, people. Love you guys.
In a world where hopium and common sense collide, starring the CryptoKeeper and BlockchainCrusader. Welcome to Debate Crypto.